Australia's central bank just made its boldest move in over 2 years, cutting interest rates to 3.6% and signaling that the economy is heading into a slower gear. With inflation cooling and GDP forecasts downgraded, what does this mean for Australia's economy and your money? On Tuesday, August 12th, the Reserve Bank of Australia lowered its benchmark lending rate by 25 basis points, bringing it to 3.6%, the lowest level since April 2023. This move was widely expected, given Australia's inflation rate has dropped to 2.1%, near the bottom of the RBA's target range. Two key factors drove the decision. Falling inflation has cooled consumer demand, and the RBA now expects GDP growth of just 1.7% in 2025. Weaker public spending and muted consumer demand means the economy is losing steam. This comes amid global trade changes. The US imposed a 10% baseline tariff on Australian exports, yet the RBA says these have had little discernible impact so far. However, the bank warns that more severe global trade disruption can't be ruled out. Markets reacted modestly. The ASX 200 rose 0.3% after the announcement, while the Australian dollar slipped to 0.6501 against the US dollar. Investors now see this as a signal that more cuts could follow. Commonwealth Bank predicts another rate cut in November 2025. Capital Economics Project's rates could drop to 2.85% by mid-2026. For households, this could mean lower mortgage repayments, but also recognition that job growth may soften. The RBA is walking a fine line, easing pressure on households without reigniting inflation, while keeping an eye on global trade risks. Whether this marks the start of a longer rate cut cycle will depend on how quickly growth recovers. With interest rates at their lowest in more than 2 years, Australia is entering a new phase, one where the challenge isn't just beating inflation, but keeping the economy moving.